Hey everyone, welcome back to Corporate Decoder, the place where we decode the jargon and find the juicy stories buried in corporate reports like this one. Today we're diving into the latest filing from Praxis Funds, a company that manages a bunch of investment funds. And let me tell you, there's a lot to unpack. Praxis Funds, a company that manages a bunch of investment funds. And let me tell you, there's a lot to unpack here. So grab your coffee, settle in, and get ready for some insights, because we're about to break down their mid-year report and find out exactly what's going on behind the scenes. And if you love getting the real story behind these financial documents, make sure you're subscribed and hit that Discord community linked in the description below. Number 811856, we start with the basics. This filing is a certified shareholder report from Praxis Funds for registered management investment companies. It's basically a check-in on how their various funds are doing for the period ending June 30, 2025. So now the company itself, Praxis Funds, is the exact name as specified in their charter, and they're reporting on their activities up to June 30, 2025. So this is a semi-annual look at their performance. All right, let's get to the numbers, the juicy part, the financial tables. Now this filing gives us a peek into several of their funds, but we're going to focus on what really matters, the performance and what it means for everyday investors. Take a look at the costs for a hypothetical $10,000 investment. For Class A shares of the Praxis Impact Bond Fund, for example, a $10,000 investment would have cost you about 46 months. That's a pretty small amount, less than 0.5% of your investment. Now, check out Class I shares of the same fund. It's only $23 for the same hypothetical investment, which is less than 0.5% if you're looking to minimize costs. These class differences are definitely worth paying attention to. Let's talk about how much money these funds are managing. The Praxis Impact Bond Fund alone has a massive 1,056,117 at bounds and 447 in net assets. That's over $1 billion under management, and they're holding quite a bit too, with 527 different investments within that single fund. That tells me they're diversified, which generally means less risk, but it also means their performance is tied to a whole lot of different things. Now, what are they actually investing in for the Impact Bond Fund? Asset-backed securities make up about 5.5% of their holdings. But the biggest chunk, over half their investments, almost 56.2%, are in US government agencies, which are generally considered pretty safe investments. Let's look at their top holdings, the ones that make up the biggest pieces of their portfolio. The number one holding is FNMA, a bond with a coupon of 0.875% due in 2030, and it makes up 2% of their net assets. Then there's FHLB, a bond paying a much higher 5.5% in interest due in 2036. This one is 1.9% of their portfolio. These are the kind of big safe bets that make up a good portion of their value investments. And this next part is really interesting, looking at the asset weighting for the International Index Fund Class A, for example. We see a huge 87.8% in common stocks. That means they're really betting on individual companies to drive growth. What's also notable here is 11.3% from investments purchased with cash from securities lending. That's a significant chunk, and it's a way funds generate a little extra income. Japan is their biggest bet at over 15%. And then a massive 31% is spread across an other country category. This tells me they're diversified globally, but some of that detail is a bit vague. Their top holding is Taiwan Semiconductor Manufacturing Co. Limited, a huge player in the tech world, representing 5% of their assets. They're really betting big on tech here. Now, let's shift gears to the Praxis Growth Index Fund Class A, for instance. Their top holding is Nvidia at a whopping 12.1% of net assets. You know, Nvidia, they're the company behind a lot of the AI boom, and this fund is doubling down on that big time. Next up, Apple at over 10%. This fund is heavily concentrated in these massive tech giants. Apple and Nvidia alone make up almost a quarter of their holdings, and their asset weighting shows this focus, almost 98.3% in common stocks. It's clear this fund is all about growth stocks right now. Let's look at the Praxis Value Index Fund Class A. This one is different. Still heavily in common stocks at 96.5%, but their top holdings tell a different story. JP Morgan Chase is their number one holding at 4.2%, followed by Walmart and Procter & Gamble. Gamble, these are more established companies, the kind of businesses that are considered value plays, not as flashy as pure growth, but often more stable. This fund is smaller with around 186 million in net assets compared to the others. But look at this, they hold 661 different investments. That's a ton of companies, meaning they're spreading their bets very thin to capture growth in smaller companies. Their top holding is only 0.7%. This shows how spread out their investments are in this small cap fund. Let's examine the Praxis Genesis Conservative Portfolio Class A. This portfolio is unique. It's investing 100% in other Praxis mutual funds. This is like a fund of funds strategy for conservative investors. Almost 70% of this conservative portfolio is in the Praxis Impact Bond Fund Class I. That's a huge bet on the bond market for stability. Then we have the Praxis Genesis Balanced Portfolio Class A. Again, 100% in affiliated mutual funds, but a more balanced mix of investments. Here, the Impact Bond Fund still takes the largest slice at nearly 40%, but it's balanced with other growth and index funds. That's the balanced approach. And finally, the Praxis Genesis Growth Portfolio Class A. This one is also 100% in affiliated funds, and it leans heavily into growth. The International Index Fund Class I is their biggest holding here at 24%, followed closely by other growth-oriented funds. It's all about aggressive growth with this one. Now let's dive into the detailed holdings. For the Impact Bond Fund, we see a lot of municipal bonds here making up nearly 1%. For example, this American Municipal Power, a higher bond, pays a good coupon and has a maturity date in 2028. But the real story here is corporate bonds making up a whopping 27.9% of this fund. They've got a diverse mix, including automotive companies like Toyota and financial services giants like JP Chase. This American Express bond paying over 5% is a solid example of their corporate bond holdings. The total cost for these corporate bonds alone is over $324 million. That's a substantial investment in corporate debt. Then there are the US government agencies, over 56% in total, and specifically 7.1% in federal home loan banks. This is where safety and steady income come from. This FHLB bond with a 5.5% coupon due in 2036 is a significant holding, showing their focus on yield within safer government-backed assets. And get this, almost a quarter of this fund, 24.8%, is in Federal National Mortgage Association holdings, a clear sign of their strategy to ride the mortgage-backed securities wave. Their top holding mentioned earlier, FNMA, with a low coupon of less than 1%, is one of many smaller holdings in this category, showing diversification within this segment. Moving on to the Praxis International Index Fund, their common stock holdings are where the action is. With nearly 88% in common stocks, this fund is all about betting on global companies. Japan makes up the largest single country allocation at 15.1%. Taiwan is also a big player at 7%, and they clearly have a strategy of looking towards Asia for growth. Again, Taiwan Semiconductor Manufacturing Company is their top holding at 5% of the fund. This shows a clear conviction in the semiconductor industry. Now, the Praxis Value Index Fund Class A. This fund is all about value, and you can see it in its top holdings. JP Chase is their largest position at 4.2%, followed by Walmart and Procter & Gamble. These are established companies, often seen as safer and more stable investments. Overall, over 96% in common stocks, but the emphasis is on companies that trades at a lower valuation relative to their earnings or assets, less flashy perhaps, but potentially more resilient. This is where we see the aggressive growth strategy come to life. Praxis Growth Index Fund Class A. So nearly 98.3% in common stocks, and their top holdings are pure tech giants. Nvidia leading the pack at over 12%. You can't ignore the AI gold rush here, and this fund is definitely riding that wave. Apple is right behind at over 10%. These two alone represent over 20% of the fund's assets. It's a clear bet on the continued dominance of these tech titans. Finally, the Praxis Small Cap Index Fund Class A. This fund is all about the smaller players, with 83.4% in common stocks, but look at the holdings. Their top holding, Liberty Media, is only 0.7%. This fund is highly diversified, spread across hundreds of small companies, hunting for the next big thing. Now let's look at the top level financials for a few of these funds. The Impact Bond Fund is sitting pretty with over $1 billion in net assets. That's a massive amount of capital under management. The International Index Fund is also substantial with nearly $500 million in net assets. And the Value Index, Growth Index, and Small Cap Index funds all manage hundreds of millions of dollars. This is not small potatoes, people. The Genesis conservative portfolio is the smallest with about $24 million in net assets, which makes sense given its conservative approach. The balanced portfolio is larger with nearly $100 million in assets, and the growth portfolio is the largest of the Genesis series with over $118 million in assets. These portfolios are essentially a diversified way to access the other Praxis funds. Let's quickly glance at the income and expenses for the Impact Bond Fund for the 6 months ending June 30, 2025. They brought in over $20 million in investment income. That's a lot of interest and dividends. But expenses are close to $2.4 million. This is typical for a large fund managing this much money. Still, they made over $18 million on net investment income before considering market gains or losses. And look at this unrealized appreciation on investments. They gained over $21 million just from the value of their investments going up. This is where the real profit can come from in good markets. So overall, the fund saw close to $39 million in increases from its operations. That's a strong performance for a 6-month period. Now, this part is crucial, the notes to the financial statements, especially the section on securities valuation. The funds value their investments at fair value, which is basically the price you'd get in an orderly sale. Market prices are used when available, but for some investments, particularly those that don't trade actively in big markets, they use models and their own assumptions. This is where things can get a little less certain, especially with level 3 assets. Looking at the Impact Bond Fund, all of their investments are categorized as level 2, meaning their value is based on observable market data, but not directly quoted prices. This is generally a good sign, indicating they're not heavily reliant on subjective estimates. Contrast that with the International Index Fund, where they have a tiny amount of level 3 assets. The common stocks are mostly level 1 quoted prices directly from the market, which is great, but that small sliver of level 3 means there are some investments they have more subjective control over the valuation of. And this note about illiquid securities is important. You see that for the Impact Bond Fund, they have over $10 million in illiquid securities. These are investments that are harder to sell quickly. Without potentially losing value, this is a common risk in bond funds and can impact their ability to meet sudden redemption demands. The Impact Bond Fund has over $10 million in securities out on loan. That's a big number, and it means they're earning extra income from this activity. And they hold over $10 million in cash collateral for those loans, generally at least 102% of the value of the loan securities. This collateral is then invested to make the fund even more money. It's a sophisticated strategy that can boost returns, providing a little extra juice to their performance. Now, for my take on all this, Praxis Funds manages a diverse set of funds targeting different investment styles, from conservative bonds to aggressive growth stocks. Their financials show substantial assets under management and generally positive performance. For the period ended June 2025, the growth funds especially are heavily invested in big tech like Nvidia and Apple, showing a clear strategy to capitalize on current market trends. However, there's always a trade-off. Growth comes with higher risk, especially with concentration in a few large tech plays. The growth funds with higher risk, especially with concentration in a few large tech plays. The bond funds with higher risk, especially with concentration in a few large tech plays. The bond funds' exposure to illiquid securities is another point to watch for potential liquidity issues. Depending on market conditions, the use of affiliated funds in the Genesis portfolios creates a different dynamic where the performance especially benefits for those specific portfolios. Overall, Praxis Funds presents as a well-established player with a clear strategy for each of its offerings, but as always, investors need to understand the risks inherent in each fund type, especially those concentrated in growth sectors or dealing with illiquid assets. What's your take on these numbers? Do you think their investment strategies are solid, or are there red flags you're seeing? Let me know your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more breakdowns of corporate filings and financial news. Don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and we'll see you in the next video.